Welcome to this Nedbank Financial Market Educational Series, proudly brought to you by our online share trading division. In this educational series, we will continue with our second part, whereby we will discuss various economic indicators. Learning about the different economic indicators is essential for every client, as this will equip you to make more informed personal trading and investing decisions. As a client, you want to make money. However, there are more to these terms than meets the eye. We establish in the first part what are economic indicators and why they are important, as well as the different types of economic indicators. We also discuss gross domestic product, interest rates, currency strength, equity markets, and unemployment and wages. We will now continue with other important macroeconomic indicators. Please note that this session is both a beginner and intermediate level. Please refer to our disclaimer. In summary, you cannot regard this session as any trading or investment advice and is only for educational purposes. Let's start this session. In this series, we will continue with the following most important economic indicators which investors, traders, and analysts use to establish the well-being of a country's economy. Consumer Price Index, or CPI, Producer Price Index, or PPI, Balance of Trade, or BOT, the housing market, retail sales, and lastly, commodity prices. The first economic indicator is that of the Consumer Price Index, or CPI. The CPI measures changes in the cost of goods and services paid by consumers in a specific month. It primarily compares the cost of living over time and so can be used to scale inflation levels. Market participants pay close attention to the CPI for signs of inflation, as rising inflation can cause higher interest rates and reduce interest borrowing, while deflation can lower interest rates and stimulate lending. Most countries will have their own consumer price index. It is important to keep an eye on the consumer price index for any country you hold a vested interest in, whether that's a position on equities, indices, or currencies. CPI is recognized as one of the leading indicators of inflation. However, it is crucial to remember that it is a delaying indicator, so it may not be accurate for current levels of inflation. As with other indicators, Consumer Price Index is best used as one part of your total analysis strategy. The next economic indicator is the Producer Price Index, or PPI. The PPI tracks price changes in goods-producing sectors. These goods include mining, manufacturing, agriculture, forestry, and fishing, and an increasing number of non-goods producing sectors. The PPI measures changes in the selling prices for finished goods, intermediate goods, and crude goods across thousands of companies. The PPI assesses costs from the perspective of industries, whereas the CPI measures prices from the perspective of consumers. The PPI is considered a great tool for looking at how prices change over the long term. They are often seen as a leading indicator for inflation, as the surveys show price changes even before they appear at a retail level. The PPI is also usually the first inflation data released in a month, so it is the first insight investors get. Balance of Trade, or BOT. BOT is the difference between the amount a country exports and imports over a given period. A country that has a higher level of imports than exports in terms of value is seen as having a trade deficit, and a country with a higher level of exports than imports has a trade surplus. A trade surplus is generally seen as more desirable than a deficit, as it shows there is more money coming into a country than there is leaving it. Deficits can be a sign of domestic debt and even result in the national currency falling in price. On its own, a balance of trade tells us little about the economic well-being and health of a country and should always be considered alongside other economic indicators. The next economic indicator is the housing market. The housing market is a vital source of information about the economy. A decline in the number of new housing projects, known as house starts, or the price of properties, shows that few people are looking to buy. A weak housing market has knock-on effects to the rest of the economy. It reduces homeowner wealth, lowers employment in construction, and can force homeowners to default on their home loans. Data on construction and prices are readily available for both commercial and residential builds. The housing market is a popular leading indicator for economic activity, as companies need to apply for building projects 6 months before they intend to start constructions. These housing start stats show whether the demand for homes is rising or falling. Let us discuss retail sales. Retail sales is the data that monitors all purchases of finished goods and services by consumers and business. It is incredibly important as consumerism accounts for a large portion of economic activity. In general, increasing retail sales is an indication that the economy is improving. If consumers are confident in their economic circumstances and future of their situation, they will continue to buy products and fork out money on items that aren't necessities. This causes levels of manufacturing to rise in line with demand and boosts GDP. It can also have a direct impact on the share prices of the companies involved in creating consumer wants. These shares are known as cyclical shares. However, when consumers start to feel uncertain about their economic future, they will stop buying unnecessary items and restrict their spending. During these times, defensive shares, those of companies involved in producing consumers' necessities like food and utilities, will tend to outperform the market. To combat the decline in spending, governments often implement tax reductions in order to give consumers more money to boost spending. However, retail sales alone don't necessarily provide an accurate picture of public spending. For example, it could be the case that people are taking out loans in order to continue spending. Although this would show continued high retail sales, but the debt levels would indicate an impending recession. The last economic indicator is commodity prices. Commodity prices are considered good macroeconomic indicators because their market prices often change before other lagging indicators. An economy-wide increase in demand for a commodity such as wood, iron, and oil can be seen as a sign that an economy is growing. These supplies are often needed for building infrastructure, and so the largest importers of commodities are emerging market economies. When demand for these commodities decrease, it is a symptom that the economy is contracting and building projects are ceasing. Certain commodities, such as gold, will increase in price during economic downturns. Gold is considered a safe haven asset, so investors consider it a store of value during periods of economic uncertainty. If the price of gold rises, it can be a sign that the economy is slowing, and investors are seeking out more stability. If the price of gold declines, it is a sign that investors are moving their money into higher risk assets. Let's summarize macroeconomic indicators. Macroeconomic indicators are statistics or data readings that reflect the economic circumstances of a particular country, region, or sector. Macroeconomic indicators will vary in their meaning and the impact that they have on the economy. The most widely used indicators are those published by respected sources, such as governments, supranational bodies, and non-governmental organizations or NGOs. Macroeconomic indicators are important to any trader and investor because they can have a significant influence on market movements. Most macroeconomic releases happen on specific dates, which means that traders and investors can prepare for their release and the subsequent market volatility. You can use an economic calendar to prepare for data releases. Popular leading macroeconomic indicators to watch include the equity market, the housing market, interest rates, producer price index, and retail sales. Popular lagging indicators include GDP growth rates, the consumer price index or CPI, currency strength, balance of trade, labor market statistics, and commodity prices. The importance of data can vary from country to country, so it is important to know key indicators by region. This concludes this session. This educational session was brought to you by Nedbank Online Share Trading. Any examples used in this session are purely for illustrative purposes. Thank you for your time.